Good morning and welcome to Financial Accounting. Today's actually going to be a little more spring-like than the last couple days. High of 48, maybe a little bit of rain though, so I guess that comes with the territory this time of year. As always, we'll start with looking at our calendar. So I'm on the April page, and you can see ahead then. The Chapter 9 problem should be submitted today if you're done with that. However, as we said in class on Monday, there is going to be a drop-in review session tomorrow afternoon starting at 2 o'clock from 2 to 3. You're welcome to come for some or all of that if you'd like. If you plan to attend, please go into Starfish, go into the courses area, and by my name under this course, you should see a link that says review. If you click on that, you just want to sign up for the drop-in review for Business 1510, and then you will see the option for tomorrow show up. And so please make sure you're registered for that, and you'll get an email from Starfish with the Zoom link to join us. At this point, what I know we will be going over in that session is the Chapter 9 problem. So if you need that review session, please do not feel like you need to submit your work today if you're going to continue to work on it after today. If you can't make that review session, but you still want to be able to work on the Chapter 9 problem, I will be recording that session, and we'll make that video recording available as soon as possible after the session ends tomorrow. Other things we could go over in that session would be some of the exercises from the practice set for the exam that you should be completing this weekend. And so I would encourage you, if you plan to attend that review session and you think it would be helpful to go through some of those review practice set exercises, take a look at those in advance so that you know which one or ones might be most beneficial for you to go over in that session. And we can, there isn't time, I'm sure, not time to do the Chapter 9 problem and all of the practice set, but we can do whichever ones you think would be most helpful. Then because today we're going to be starting Chapter 10 on current liabilities, then the Chapter 10 pre-quiz should be submitted for grading by the end of the day. And so looking ahead, then as we discussed on Monday, the third part of the project, and we talked about that during class on Monday, looked at all of the requirements for that, and the third exam should be submitted for grading by the end of the day on Sunday. The projects, as always, are submitted in Blackboard. The exam is in Cengage, See Now. There is a 3-hour time limit unless you have accommodations that allow you extended time for testing. If you're prepared for the exam, 3 hours is way more than you will need or want to use for that exam. But remember, once you start it, you cannot pause it and come back to it later. And once you start the clock, it starts ticking, and it keeps going for the full 3 hours until you submit. We'll be covering Chapter 10 starting today. It's not on the exam, of course. Remember that our next exam covers only Chapters 10 and 11, so it does come up on us pretty quickly after Exam 4. In fact, if we didn't have that spring break in the middle, there would be just 2 weeks between those exams. And then as we look ahead to the end of the semester, we'll have 3 more chapters, 12, 13, and 14 for that last exam. The exam is not cumulative. We'll be finishing up Chapter 14 here on Monday the 9th. Officially, we do have class on Wednesday the 11th, but there will not actually be a class per se. I will be available. I can come to the classroom if people are going to be on campus and need assistance. Otherwise, I will be available in my office. I can be available on Zoom if you have questions, if there's anything that you need to go over as you're finishing up that work. But the end of the new material will be here on Monday the 9th. And then that last exam, which again is not cumulative, it covers only chapters 12, 13, and 14, needs to be submitted along with any other work that might be outstanding by Friday the 13th, because grades are due. And Friday the 13th is the schedule, would be the normal graduation date. Let me say it that way. I believe that the graduation ceremonies will be Saturday and Sunday. We've had some changes from past practice, of course, because of COVID, but traditionally, the Olean campus graduated on Friday night, and the Jamestown campus would graduate on Saturday at midday. So, questions about where we're going? We can see the light at the end of the tunnel. As a reminder, those of you who are in the business and entrepreneurship community, which is most, but not all of you, if you do plan to return to JCC for either summer or fall classes, registration is starting very soon. So you should be looking to make an appointment with your advisor. You should be able to see your advisor in your Success Network in Starfish and make an appointment right from there. And if you don't see an advisor, it's possible, although not likely, that you do not have an advisor assigned to you. And if you just check in with me, I'll be happy to point you in the right direction. Either I can help you with that process, or I can point you to the appropriate person to help you with registration. Registration starts on Monday, April 4th, next Monday, for people who are military veterans or are in the JCC Honors Program. For everyone else, registration starts on Monday, April 18th. And so it's a good idea to get your appointment and get with your advisor so that you can get in on the classes that you really want. The schedule should be available online by the end of this week if it's not available already. All right. Any questions? I know that's a lot of information, but key points, make sure you get signed up. If you plan to return to JCC for summer and or fall, make sure that you get signed up with your advisor. If you don't know who your advisor is, you should be able to find that person in Starfish. And if you can't find it there, I can help you with that. If you want to attend the review session tomorrow to go over the Chapter 9 problem and possibly part of the practice set for the exam, please sign up for that in Starfish as well. Okay. Questions about any of that? Today's the last day of week 10. And so starting tomorrow, we have exactly 5 weeks of class left. You're 2/3 of the way through the semester. Okay. Before we start the new material, which as you know is not on the exam, is there anyone who has questions on anything chapter 7, 8, or 9, the 3 chapters that we have just concluded and are covered on the exam this weekend? If not, we will get started with our new material. Again, this information is not on the exam. And you will notice the first few exercises that we're going to do today feel a little bit like review, because as you can see in the name of the chapter, installment notes or notes payable is a big part of the first, or is the point of the first 3 exercises that we do, maybe even 4. And so we've already talked about the same concepts from the receivable side in chapter 8. So now we're just going to be looking at this from the viewpoint that we are no longer the lender, but we are now the borrower. And so we have a payable. These 2 chapters that are on exam 4, chapter 10 and 11, focus on the liability section of the balance sheet. So if you think about where we have come from January in the past 10 weeks, we have covered the basics of accounting, the fundamental accounting equation, the concept of debits and credits and double entry accounting, and using T accounts and writing journal entries, doing adjusting entries, closing our books for the end of the period, preparing financial statements. That really took us through chapter 5 as we started talking about specifically a merchandising company and how their accounting system works, or what their accounting cycle looks like. Then in chapter 6, 7, 8, and 9, we were focused on specific parts of the balance sheet. So we looked at cash, receivables, inventory, and then we looked at the long-term assets in chapter 9, property, plant, and equipment, intangible assets, natural resources. So now we're kind of done with what I think of as the debit side, or the left-hand side of the balance sheet, where we're analyzing all of those assets, all those different kinds of assets, and the accounting issues that are related to them. In this chapter and the next chapter, then, the 2 chapters that make up exam 4, we look at the liability section of the balance sheet. And in this chapter, we're focused more on the current liabilities, the things that come due sooner. And then in chapter 11, we will be talking about long-term liabilities. As we conclude the semester then, chapter 12, we look at the final section of the balance sheet, which is the stockholders' equity section. So we haven't spent much time talking about those considerations yet this semester, but we will focus on those exclusively for chapter 12. Then chapter 13, we look at the 4th of the 4 financial statements that all publicly traded companies are required to prepare and have audited on an annual basis. That makes up the statement part of the annual reports that you've been looking at for your company that you selected for this semester. So in chapter 13, we look at the cash flow statement, which is the 4th of those 4. Income statement, statement of stockholders' equity, balance sheet, and then the cash flow statement. And at the very end of the semester, our final chapter is looking at financial statement analysis. So we've been talking about, in many of our chapters, different ways that we can look at financial statements to help us make decisions about that company. But we're going to pull all of that together to wrap up the semester, to wrap up the financial accounting portion of the course. If you look in your textbook, you will notice that it's actually 28 chapters long. And we cover 14 this semester in financial accounting. For many of you, if you are, in particular, if you're one of the business degrees here at JCC, or really any place in the world where you're earning a degree in business, there is always that 2-semester sequence of accounting that is required. And for most of you then, next semester, you will be taking Business 1520, which is managerial accounting. In that class, we cover chapters 15 through 28. So you will be exposed to the rest of the book. For those of you here, and I know we have a couple people taking this class who are not actually business majors, but might be a different major, such as health information technology, administrative professional, or sport management, something like that. I would encourage you to consider taking that 2nd semester of accounting if it fits into your degree as an elective. So for those degrees I just mentioned, the managerial accounting is not a requirement, but it will help you to see the rest of the picture. So the internal part of the accounting, which is what managerial accounting is, helping decision makers who are inside the company make decisions about that company and how to run it more efficiently and more profitably. So even if it's not a requirement for you, I would encourage you to consider whether that would fit in. Talk to your advisor as you're talking about next semester and see if that would make sense for you. Questions about that before we actually get into this chapter? So as I said, our first few exercises relate to notes payable. And since we've already talked about this from the receivable side, I don't think we need to spend a lot more time talking about those considerations. So we'll go right to those exercises that relate to notes payable after I show you the rest of the learning objectives for this chapter. So we should be able to move right along with the notes payable exercises and then get into the newer information for us, which would include other current liabilities. And specifically today, once we finish the notes payable part, we'll be looking at payroll accounting and some payroll liabilities that we might encounter. So it'll take me a little bit of time because I like to give you more information than what's in the book to make sure that you are aware of how that works, because you know most of us are probably employees at some point. Most of you, and obviously I, have jobs right now. And so you're drawing a paycheck, but my experience has been that you may not really have a firm handle on everything that's happening in that paycheck. But we'll get to that shortly. Let's go to our first exercise. Oh, whoops, I check those due dates. I went out of my exercises. Here we are. Let's go to our first exercise. And as I said, the first couple exercises do relate to notes payable. So we know that notes payable, we're now going to be looking at the borrower side. I like this first exercise because it actually has you look at both sides of the same transaction. So we will record journal entries for both the borrower and the lender, both the maker of the note and the payee of that note. So in this exercise, we are told Bennett Enterprises issues a $400,000, that's the principal or the face value of the note, 90-day, that's the duration or the maturity length of the note, and 5%, that's the interest rate, and that would be an annual interest rate. So the borrowing is occurring for about 3 months, about a quarter of the year, but the 5% interest rate refers to the annual interest rate. And they issued this note for merchandise inventory. So Bennett is buying some merchandise inventory from Spectrum, and they are asking for maybe some additional time to pay for it. Say, you know what, we're not going to be able to pay for that right away. Could we pay you in 3 months and we'll pay you interest along with that? So we need to use that simple interest formula that we had learned in the prior chapter. I equals PRT, principal times rate times time. And I'm going to go ahead and do that interest calculation right now since I have my annotate on here. It'll get easier than jumping back and forth. So the principal of the note, $400,000. The interest rate, 5%. And the time period, remember we need to express that so that the units of the interest rate, annual, matches the units of the time period. So since the time period was in days, we need to change that into portion of a year. And we're told to use a 360-day year, really just because it makes our calculations easier, cleaner. And what I found was interest of $5,000 will be due on that note when the note comes due in 90 days. We spent time in that earlier chapter doing interest calculations and also due date calculations. In this exercise, we are not required to do that. Rather than using dates here, they're just numbering these 1 and 2. But of course, we know if we were putting this into our financial records, we would have dates there. The date the note was made or issued, and then the date the note matures and is paid along with that interest. Everybody good up to this point? Okay. So again, Bennett Enterprises issues the note. They are the maker of the note. They are the borrower. They issued the note for merchandise inventory. So one account that's going to be affected isn't that interesting? So did I just miss it? Oh, there it is. Okay, I just didn't see it on the list. I was looking specifically for merchandise inventory, and apparently I just looked right over the word that said inventory. So one account that's going to be affected is inventory. They now have $400,000 worth of inventory that they did not have before this transaction occurred. Just to see those connections with what we've covered in earlier chapters, in chapter 5, we discussed the difference between perpetual and periodic inventory systems. It must be that Bennett Enterprises uses the perpetual inventory system, because if they used a periodic inventory system, they would not make this entry directly to inventory. Instead, it would be in a separate account called purchases or merchandise purchases. So now, again, Bennett, using a perpetual inventory system, has $400,000 worth of inventory that they did not have before. But what else do they have? They have an obligation to pay for it. And how did they pay for it? They issued a note payable. They made a note. This would be a current liability because it's due in 90 days. If they had issued a note with a duration or maturity length of more than 1 year, which could happen, that would be a long-term liability or a non-current liability. Our definition of current liability, I'll remind you from what we talked about in chapter 4 when we introduced the classified balance sheet. Long-term liability is something that is going to be paid in more than 1 year or is not being paid or relieved, taken care of, using current assets. A current liability generally is due within 1 year, and we use current assets to pay for it. So a note payable could be a non-current or a long-term liability if we were paying for it with something other than a current asset. Just a reminder. Now, let's go down to Spectrum. So Spectrum Industries is the seller of that inventory. And so when they, receive the note, when they sell that product, they're going to record the revenue from the sale and the note receivable, which for them, again, would be a current asset. So you can see these transactions are kind of mirror images of each other. Bennett receives inventory, Spectrum reports sales or revenue. Bennett has a payable, Spectrum has a receivable. Because I reminded you about perpetual versus periodic inventory systems, I will suggest that Spectrum must not be using a perpetual inventory system, or there would be another entry here. And as we discussed in chapter 5, the other entry would be if they used a perpetual inventory system to remove the inventory from their inventory. And it would be, we hope, for some dollar amount less than $400,000. Hopefully they're not selling the inventory for exactly what it costs them, because then they're not covering their operating expenses and not making any money. So there could be another entry here. We are not showing it either because Spectrum does not use a perpetual inventory system, or because we're just leaving it out because it's not as it's not related to what we're doing here with notes, receivable and payable. Okay, so now 90 days passes and Bennett is going to honor the note. They're going to pay how much they owe. So they're going to be using cash to make that payment, they're going to pay the $400,000 face value plus the interest of $5,000 that we already calculated. So they're going to use cash. And if Bennett pays out cash, then Spectrum must be receiving that same amount of cash. Why is Bennett paying that cash? Paying that bill? Because they are paying off the face value of the note payable. So we want to debit notes payable to get that off our books. We no longer owe that amount. And they've also incurred $5,000 worth of interest expense that's going to show up on their income statement. So everything else about these transactions for Bennett Enterprises happened only on the balance sheet. The borrowing happened only on the balance sheet. Okay, the borrowing does not affect their income statement. The only part that does is the recording of this interest expense. Make sense? So as we go down to Spectrum then and finish this up, just like Bennett no longer has the note payable, Spectrum no longer has the note receivable. And just like Bennett recorded interest expense, Spectrum is going to record interest revenue. And so you can really see with this exercise the two sides of that transaction. Put my green check marks in there. Any questions about recording notes receivable, notes payable? And it's mostly review of what we have done in chapter 8. All right, we'll keep going then. So all of the notes that we looked at in chapter 8 and the note that we just looked at in our first exercise were where the maker of the note borrowed the full face value and then paid interest on top of that note. Well, there's another type of note payable referred to as a discounted note payable. If you are a borrower, you would prefer not to have the discounted note payable. And if you were a lender, it actually works out in your favor to have a discounted note payable. What that means is you start with the face value, but you're not actually borrowing the face value. You calculate the interest on that face value, and then you subtract the interest and you receive, as the borrower, you receive the difference between the face value and the interest calculation. So just, and we'll do these calculations in just a moment, but just to put some numbers on it, let's say the interest worked out to be $500. Well, you would receive then $59,500 and pay back the full $600. So what happens, and we're not going to go through the calculations, but if you're interested and want to try it on your own, feel free to do that. What happens is you actually end up paying a little bit higher interest rate because the interest is based on the $60,000, but that's not how much you received. And so that is why if you're a lender, you like the idea of discounting the note. If you're a borrower, it doesn't work out as well for you. The effective interest rate actually ends up being a bit higher than the stated, in this case, 8% interest. So let's see how that would work for this particular exercise. We're going to use that same simple interest formula. So let's calculate what the interest would be. We use the face value of 60,000 times the interest rate times the time. This is a 60-day note, and we're using a 360-day year just to make our calculations fun. So what I found was interest of $800. Does everyone agree with that? Okay. I always like to get the agreement because, you know, I could have frequently made mistakes on this calculator as I'm still getting used to it. I use the same calculator for about 25 plus years. You know, you get used to how it works, and this one does not work the same way. It's user error. It's not the calculator, it's me. I know. So the interest on the $60,000 would be $800. However, we're going to subtract that $800 from the $60,000 to give us the actual amount that's being received or being borrowed by the issuer of the note. A business issued a 60-day note. We're asked to journalize the entry to record the issuance of the note. So again, they're the borrower and they're going to have the liability. And so the cash they receive is not the full $60,000 as they would on a non-discounted note. The cash they would receive would be the $60,000 face value minus the $800 interest, or $59,200. Then, see, the note payable is going to be recorded at the full face value. That's how much we will end up paying back when the note matures in 60 days. And the difference between those two numbers is, of course, the interest. The reason it's okay to record the interest now rather than waiting to the end when we pay the note is because it's only a 60-day note. The assumption is that that $800, the 60 days is going to be in the same fiscal period, the same accounting reporting period. If we borrowed the note in, say, November and we're paying it back in January, is that right? If we borrowed in December and we're paying back in February, we would have to do an accrual to make an adjustment so that the interest expense was split between the two fiscal periods. The assumption we're making here is it's in the same fiscal year, same fiscal reporting period. And so if you were to do the calculation and calculate what interest rate the $800 would be on the actual cash received, you would find it's somewhat larger than 8%. It's not a huge difference. The longer the duration of the note, the more difference that will make. And now we fast forward 60 days and it's time to repay that note. So when we repay the note, as I already mentioned, we're going to pay the full $60,000 and then remove the note payable from our records. So in summary, if you're borrowing, you would prefer not to have a discounted note payable because your interest cost as a percent ends up being a bit higher. If you're lending, though, that's a good thing, that your interest that you collect ends up being a bit higher. Everybody okay with that? Okay. Exercise 3 has us look at maybe a more or less commonly used situation, but certainly it can happen, that we issue a note for a long-term or a fixed asset. So in the last chapter, in chapter 9, as we talked about fixed assets, the very beginning of that chapter, we talked about how it gets recorded. And I think as I was doing some journal entries to show you what that would look like, I said, well, let's just assume they paid cash. But in reality, when you're buying a large ticket item, an expensive purchase, you may not have the cash available to make that payment and to pay the full thing up front. And that's what we see here. On June 30th, Collins Management Company purchased land for $400,000 and a building for $560,000. They paid a substantial down payment of $360,000 in cash, but they had to issue a note for the balance. The terms of the note provided for 20 semi-annual payments. Interesting thing about the English language, this actually drives me crazy. These two words can mean exactly the same thing. Semi-annual and biannual. Semi means half, like a semicircle, and bi means two. Biannual can actually mean twice a year or every other year, and there's no way of knowing. If you see it on a page, there's no way of knowing which one it is, and that's the part that bothers me. So I strongly recommend using the word semi-annual to avoid any confusion by using the very ambiguous term biannual. It should mean just every other year. It can't, in my world, it should not mean twice a year or every other year, because those are very, very different concepts. So they have chosen here to use the much more clear term semi-annual, which means it's being paid twice a year. So if you make 20 semi-annual payments and they happen twice a year, this is a 10-year note, not a current liability. It would be a long-term liability. However, each year, the two payments that are happening within the next year become current liabilities. So in the first year, when we sign this note, when we make this note, the first two payments would be considered current liabilities because they're due within 1 year, but the rest of the 18 remaining payments would be considered long-term. And each year, we shift 2 more payments from long-term to current. Make sense? So the semi-annual payments are $30,000 on the principal plus the interest that has accrued from the date of the preceding payment. We are asked to journalize the entry to record the transaction on June 30th when they actually buy the property. Oh, let me make one more comment here because I kind of skipped over this phrase, secured by a mortgage on the property. A mortgage is an example of what's called a collateralized loan. Collateralized loan. Collateral is what you pledge in payment of the loan. So when they borrow this money, when they write the note for 500, well, we'll get to how much it is in a second. When they make the note, they say, if we don't pay, you can foreclose on the property. So you pledge that real property, the land and the building, so that if they default on their payments, the lender has recourse, can come back and foreclose on their property. And that's exactly what happens if you ever hear about property being foreclosed. The property has been pledged in payment of a loan, and when the loan is defaulted, when it's not paid as agreed, they have the right, the lender has the right to seize that property and then sell the property for what they can get from it, pay off your remaining obligation, and then if there's anything left, that would go to the original owner of the property. So that's what a mortgage is. It is a collateralized loan where we've pledged something. A collateralized loan, as you can imagine, is less risky than a loan secured by a signature. A personal loan or a signature loan has no collateral behind it. And so if you default on a signature loan, the bank or the lender doesn't have as much recourse to try to get you to pay. There's no real property that they can come and seize or attempt legally to seize from you in payment of that loan. What that means then is secured loans, collateralized loans, usually have a lower interest rate because they are less risky. That's why if you're buying a house or buying a car and there'll be a lien on the property, those loans are cheaper than just walking into a bank and saying, I need $20,000 because I want to go on a really big vacation or whatever. So that's what we're talking about here. They have pledged their real property in to make the loan secure or less risky. So let's go to our journal entry. When they acquire the building and the land, of course, we need to put the building and the land on our balance sheet. So how do we know how much those are worth? Well, we know how much those are worth because we've had them appraised, because we had an expert tell us, here's how much the building is worth, here's how much the land is worth. The total of this transaction then is $960,000. If the appraisal came in at less than that, then we would record an additional component called goodwill. So that term came up in our last chapter. It is an intangible asset. And the definition of goodwill is an amount that's paid over and above the fair market value of the assets that were the real or tangible property that was acquired. So we don't have goodwill here. We're assuming that the land is actually worth $400,000, which is what we paid for it, and the building is actually worth $560,000, which is what we paid for it. Why would a company pay more than the fair market value for an asset? Because there's something else intangible, something else about it that makes it attractive. So it might be the location, it might be the amenities that are available. It might be an existing customer list. If you're buying a going concern business, that the business itself might be worth might be worth more than the real property, the land and the building. It's the fact that we already have a customer base and an existing business. That part is considered goodwill. Okay. So we have the land and the building that we're going to record on our balance sheet. It says we paid $360,000 in cash. And so we're going to record the credit to cash to show the down payment. And then we know we can't be done because the whole point of this exercise is about a note. But we also know we can't be done because the debits and credits are not equal. So how far out of balance are they? How much do we borrow in the process of this transaction? The difference between the total of the debits and the credit to cash is $600,000. We borrowed $600,000. Yes, sir.
The
Oh, thank you. Yeah, sorry, I typed the numbers in the wrong order. Thank you. Yeah, that's definitely what it says. Land of 400,000, building of 560. Thank you. Okay. We now own the land and the building. We assume that we're using it in the normal course of operations and it's helping us to make some money. The whole reason we bought it. 6 months down the road, end of December, we have now had that $600,000 borrowed for 6 months, for half a year. And we are going to make a payment of $30,000 plus the interest that has accrued since we borrowed the money. So we need to calculate the interest. And again, it's going to be the simple interest calculation. In Chapter 11, we will learn how to do a compound interest calculation. But for now, we're just looking at simple interest. How much do we owe? Well, we still owe $600,000, the same amount that we borrowed, because this will be our first payment. The interest rate is 5%, but that's an annual rate, and this is a half-year payment. And so the interest we owe with this first payment is $15,000. Everyone agree with that? So on December 31st, we're going to make our payment of $30,000 toward the principal plus $15,000 worth of interest for a total of $45,000 that we're paying. We're going to reduce the amount that's remaining on that note. Whoops, not quite that much. We're going to reduce the amount that's remaining on that note. We made a $30,000 payment against the principal. And we're going to record the interest expense of $15,000. Now, we continue to use the building. 6 months later, we're going to make our next payment. The accounts that we're going to use are exactly the same. The principal payment is what we agreed to do. We're paying $30,000 toward the principal each time we make an installment payment. What is different, though, is the interest that is due. Because the interest is based on how much we owe. And we no longer owe the full $600,000 because back on December 31st, we made a payment toward that principal. The principal has come down, and so the interest will also come down. So we now owe only $570,000. Again, it's a half-year payment. And so rather than owing $15,000 in interest expense, we now owe only $14,250. And our payment, instead of being the full $45,000 it was back in December, we now owe only $44,250. We refer to this as an amortized loan. Put that word on the screen. We refer to this as an amortized loan because in the root of this word here, mort. Anyone know what that word, that root refers to? Mort, what does that mean? You know what a mortician is, or a mortuary? Mortal, you know what mortal means, right? It means you can be
like dead people or something.
Yeah, so mort refers to death. Okay, the root word mort refers to dying or death. And so an amortized loan is one that we are gradually killing off or working down over the time. So although this is a note, it's an installment note, it's different than the notes we've looked at up to this point because we don't pay the full thing, the full note at one point. We're paying gradually over time. And so on this amortized note, as we make the payment, the principal will come down. Now, what makes this different than a traditional or a typical car payment or a house payment, a mortgage, is that we agreed that we would pay the same amount, $30,000 toward the principal and whatever interest we owe from the last payment. Where a traditional mortgage or a car payment, typically in an installment loan like that, your payment is the same every month. And so you see a shift from at the beginning of the loan, you're paying relatively more in interest and less in principal. And as that principal comes down, the part that is interest goes up and the part that is principal is going to go down with that same payment every month. the ratio, the split between interest and principal goes, shifts from more principal to relatively more interest. I said that back. I just said that backward, what I just said. Let me say that again. When you get toward the end of the loan, as your principal has come down, more of your payment goes toward the principal. And I totally said that backward. I apologize. Don't seem to be able to speak today. So this is an amortized loan because you're gradually amortizing or killing off that principal balance. Each time we make a payment in this style, we're going to be paying the $30,000 toward the principal and a smaller and smaller amount toward interest as the loan gets closer and closer to its payoff date in 10 years. Okay. So any questions about installment loans as we did here? And I should probably say, I don't know how typical this would be for a business borrowing. I would suspect for planning purposes that normally this loan would be what we're used to seeing, which is the same payment every time. But the reason they had us do it like this for this exercise is because it makes the calculations cleaner for us. But I'm not suggesting this couldn't happen. I just don't know how prevalent this is. Any questions before we move on? Excuse me. Okay, our last exercise then before we get to the concept of payroll and income tax. And that will take up the balance of our class for today. In exercise 4, we're looking at information from PepsiCo's balance sheet. And they disclose the following information in the notes to their financial statement. So what we would see on the balance sheet would be how much do they owe. In the notes to the financial statements, you'll find additional information about when those borrowings are due, what interest rate they're paying. You might see a series of notes. They might have some bond issues in there. You are, on your project, you are asked to find this information when you get to this chapter. You're asked to find that information, and you will find it not on the balance sheet itself, but in the notes to the financial statement. You may, for that project, want to just copy and paste or do a screenshot snip of that table that you will probably find in the notes to your company's financial statements. The vast majority of companies have long-term debt like this. In fact, we spend most of chapter 11 talking about long-term debt and bonds because it's the most frequently occurring way that corporations borrow money. It's actually one of the advantages of being a publicly traded company is you have access to the capital markets, not only by selling your stock, but also by selling bonds to the public. So we'll talk about that more next week when we start chapter 11. For our purposes here, though, we're asked, looking at the information that's provided here, how much of the long-term debt was disclosed as a current liability on the current year's balance sheet? And we are told right here, the current year, the current portion of the long-term debt was $4,096. Now these numbers are in millions. I know the millions label belongs on there, but for the sake of ease, I'm just going to say the numbers that appear in this table, but you do need to keep in mind these numbers are in millions. So the part that would be a current liability would be $4,096 million. how much did the total current liabilities change between the preceding and the current year as a result of the current portion of long-term debt? So our total current liabilities last year, the current portion of our long-term debt was 2224. Now it's 4,096. So how much did it change? It was an increase of 1872. Keep in mind that almost always the information for consecutive years appears in what I will call reverse chronological order. That is, the newest information appears to the left, and as each new year is popped in, the older years are pushed off to the right. The reason we do it that way is not to be confusing, but because we assume that the current year is the one that you're most interested in. And since we read from left to right, it makes sense to put the current year, the part that's most of interest to us, closest to the description, closest to those account titles. Those are the first numbers you're going to encounter. Okay. If PepsiCo did not issue additional long-term debt next year, what would be the total long-term debt on December 31st of the upcoming year? And so the assumption is that they would pay off the 4,096 that they owe that's current this year. And what would be left is the 23,821 if they issued no new long-term debt. Most likely, part of that 23,821 would become current next year. Most likely, some of that is due next year. $4,000 of it is due this year. Probably some of it is also due next year. Maybe not, but probably. If you looked at the table of information that was provided along with this part of the information, you would be able to see that because it would show you the due dates or the maturity of all of their debt individually. Each issue is going to show how much they borrowed, what the interest rate is, when it's due. They are required to disclose that. Okay. Questions, anybody? Any questions at this point? Okay. So what we're going to do next is talk a little bit about payroll. And in order to do that, I have pulled up some resources here to just share with you. But first I want to tell you a little bit of a story. And I am not doing this to poke fun at the individual. But I want to share with you why I think it's important to cover not just what's needed for these exercises, but to talk a little bit more about how payroll and how tax liabilities, tax obligations work for us as employees. Because here's what happened. This was several years ago now, and the person in question no longer lives anywhere near here. But I was teaching a financial accounting class, different classroom down the hall at that time. And it was the end of class and most people had left, and I had just had a couple students left in the room that were still working on something. And so I had this student, her name was Sarah, and I was trying to explain something to Sarah about income tax calculations on a corporate income statement. And she's just looking at me like I was speaking some other language. And I didn't understand what she was not understanding, because to me, it was just, information that everybody would have. And she finally looked at me and said, "Do you mean that companies have to pay taxes based on how much they earned?" And I said, yes, they do. And so do you. And she was so startled by that. She's a young girl, just out of high school. And so I asked her, did you ever have a job where you were paid legitimately, not under the table? Did you ever have a job where you got a regular paycheck? Oh yeah, I worked at the candle factory last summer. I said, okay, so when you got your paycheck, did you notice, and I was just describing what would be on a typical paycheck where you've got your hours worked and the wage that you get paid and there's the total. Then there's some other numbers and then there's the amount that your check was actually for. And she said, oh yeah, I wondered what that was about. It happened to be a spring semester, so it's just about this time probably. And I told her, you need to go home and talk to your parents. I knew she lived with her parents. You need to go home and talk to your parents about this because it's tax time and you probably are owed some money. She happened to live in Pennsylvania, so she probably wasn't owed a whole lot because they have a flat tax rate. We'll get to that in a moment. So it was just really eye-opening for me. I grew up in a house where my father owned a business and we ate dinner together every night. And there was lots of talk about taxes and business taxes and personal income tax at the table. And so I grew up just knowing those things. And, if I can say one thing about my 20 plus years of teaching, I've learned, I hope, not to assume that people know stuff that maybe they don't know because their situation has been different. And so that is why I am going to take probably the remainder of our class today talking about, and hopefully we'll get to an exercise, but talking about how the tax system works. Because if you are an employee, you are paying taxes. And I think it's part of being an informed voter to understand exactly what you're paying and why. So that's the story. It's why we're going to talk about this, why I think it's important, because I think everyone has an obligation to understand how it works. So we'll start with, you get a job. And again, I'm talking about a legitimate job, meaning a legal job. I am not talking about getting paid under the table. That's a whole separate set of considerations. I will just throw out there from a personal standpoint, you're breaking the law if you're doing that. I know lots of people do it. It's not right, it's illegal. And it shifts a lot of the burden onto other people who are law abiding. So that's all I'm going to say about that. But eventually I'll tell you another story about a different student in a different semester and my experience with the understanding of what it means to be working under the table in an illegal job. When you get a legal job, you are actually an employee, not an independent contractor. If you are, an Uber driver, you are an independent contractor. Your pay works differently. You get paid what is called 1099 income as opposed to W-2 income. And so most of you probably have a job or had a job last year, even if it was just over the summer, and you would have received a W-2 from your employer, around the end of January, showing how much money you made last year, how much was withheld. Can't really show you a W-2. We could show you what one looks like, but I can't show you a completed one because that would be a confidentiality issue. But when you get a job, in order to pay you, your employer needs to have you complete what's on the screen right now. This is called a W-4. If you've had the same job for several years, this may look a little bit different than what you completed at the time you started your job because they have completely revised this form in the wake of the 2018 tax reform. In Blackboard, to the reference materials. So in Blackboard, the reference materials for this chapter, you'll see some links that are related to what we're going to talk about today. I have a link to the federal income tax brackets. It says 2020. I updated that link today, so it includes the 2021 brackets as well. And we'll be looking at those right here. There is a link to an article that talks about the 2018 tax changes. So if you're interested in what I just said, you may want to take a look at that. But there was at least a partial overhaul to the federal tax system, including the elimination of exemptions. And so it used to be that on your W-4, you would report how many exemptions you were claiming, and that would be the number of people, basically, the number of people that are living in your household. So if you're married and have 3 kids, you'd be claiming 5 exemptions, 1 for each of the people living in your household. You do report your filing status. There are 5 separate filing statuses, but there are only 3 options for your withholding certificate. If you have multiple jobs, the withholding calculations will not work out quite the way they should, because your withholding is based on just that job that you're being paid. If you have dependents in the household, you can claim those dependents and reduce your withholding. So again, you're going to fill out this W-4 form, sign it, give it to your employer, and that tells the employer, as you get paid each pay period, that tells the employer how much of your pay should be withheld for federal income tax purposes. If you live in New York State, our New York State system follows the federal system, and so this also will inform your New York State withholding. As I mentioned, if you live in Pennsylvania, the Pennsylvania withholding is based on a flat rate, a flat percentage. Everybody pays the same percentage. There are some exceptions to that for low-income people, but in general, they have a flat or proportional tax. So you fill out this W-4, and then your employer knows how much needs to be withheld. We'll focus mainly on the federal tax because, of course, that applies to everybody who lives and works in the United States. Excuse me. Back in chapter 3, when we were talking about adjusting entries, we looked at adjusting entries for wages. And I had asked the question in class at that time, so how many of you have ever had your boss pay you early because the 1 month was ending, and nobody said that it happened to you, but in that context, I had asked, so when do you get paid? And some people said like every other Wednesday, every Thursday, every Friday. Another option is twice a month or semi-monthly. What I have up on the screen right now is the current, so 2022, these change every year. These are the current withholding tables for federal income tax purposes. And so you'll notice that this one in the heading says it's for weekly payroll. So if you get paid every week, you get paid 52 times a year generally. And so your employer would be looking at this. Based on the information that you marked on that W-4, your filing status, are you married, filing jointly, head of household, or single or married, filing separately? You'd be going to the set column. And let's say you are single, because I suspect most people here are single. You'll be looking at these columns, and then you go down this left-hand set of columns to find, okay, where is your income for the week? So let's just say, because it happens to be where I am, that your income is $400 for the week. So that would be in this range, at least $395, but less than $405 for the week. We come over here to the columns for single, and if you do not have the W-4 checkbox, additional withholding checked, you would have $15 of the $400 withheld. Your employer holds that money until it's due to the federal government. They make regular payments throughout the year where they remit or send in all of the withholding that they have kept on behalf of their employees. So that's how withholding tables work. You'll notice that there are lots of range there for income. If it goes over a certain amount, then you do the calculation manually And there's a, earlier in this document, this is a 68-page document, as you can see, publication 15T. And earlier in the document, it tells you how to calculate for those higher levels of income. This is for a bi-weekly pay period, so you get paid every other week. If you keep scrolling down, you'll see semi-monthly, so you get paid twice a month, which is only 24 rather than 26 pay periods during the year. And then we have monthly payroll period. And so based on how often your employer pays you, they are going to use the correct form to make sure that they're withholding the appropriate amount. The goal should be that at the end of the year, when you prepare your tax return, that the amount that you've had withheld closely approximates the amount that was due. So ideally, this is my financial perspective, ideally you don't want to have a lot of extra withheld because you're basically giving the government a an interest-free loan for the year by allowing them to take more out of your paycheck than what you reasonably would expect to owe. So how are these calculated? Well, I'm going to go to my next, I don't know, what do I want to call this? My next resource. This is what I have linked in the resource file for you, and these are the tax brackets. The page that I have linked includes both the 2020 tax brackets and the 2021 tax brackets. So these are what we're going with right now, the 2021 tax brackets for people who are filing their taxes right now. There are 3 different types of tax systems in general. And if you've taken an economics class, you may have learned about these there. There are progressive, proportional, or what some people refer to as flat, and regressive. Regressive. And the distinction between these 3 systems is as a percent of your total income. A progressive system takes a higher percent of your total income to pay that tax if you make more money. And a regressive system takes a higher percent of your total income to pay that tax if you make less money. The federal income tax rates are progressive. And so as you look at these tax brackets, you can see what's called the marginal tax rate. If your taxable income is between, close that, is between, where did it just go? There, it just froze on me. So if your taxable income, I'm just going to round off here, is between $0 and about $10,000, you're going to pay 10% of that taxable income as federal income tax. It's called your marginal tax rate because it's the tax you pay on the last dollar you earn. Everyone pays 10% tax on the first about $10,000 that they make. That's taxable. I'll get to that in a minute. Over 10,000 up to about 40,000, you're going to pay 12% of that income, the $30,000 roughly in that tax bracket, you're going to pay 12% of your income. The next $46,000 worth of your income is taxed at 22%. After that, the next 80,000, rounding, pay 24%. So these are the tax brackets. There are currently 7 tax brackets in the federal income tax structure. It is progressive because the more income you make, the higher a percent of your income goes to federal income tax. Does that make sense to everybody? You notice there are separate brackets here for single, married filing jointly, married filing separately, head of household, those filing statuses that we saw on the W-4. You have to tell on your W-4 which one of those you are using, which one applies to you, and your withholding is based on that, and your tax ultimately is based on that. Okay, so the federal income tax structure is progressive. The New York State income tax structure is also progressive. The percentages are much lower than the federal, but they're still very high compared to other states. Yord Angel, I'm going to call you out because you are from Florida, and Florida is one of the 7 states that does not have a personal income tax at the state level at all. New York's is, I tend to think that people in this state were somehow proud last year to reclaim the title from California of being the most highly taxed state in the country. I don't personally think that's something to be proud of, but people seem to be pretty excited about it. We fight with we are head-to-head with California. Connecticut's another one that is a very highly taxed state when you look at all of the additional taxes that we pay on top of federal income tax. So some states don't pay state income tax at all, including Florida, Alaska, Texas, some smaller states like Delaware. Some states pay a progressive tax like what we're looking at here. And some states like Pennsylvania have what's called a proportional tax. Some people call it a flat tax because it's a flat percentage that you pay. But I think proportional is a better term for that. It's a little less misleading. A regressive tax, as I already suggested, is one that hits lower income earners harder. It does not mean that they pay more dollars for that tax. It means as a percentage of their income, they pay more. Believe it or not, sales tax, go back, thank you. Sales tax is a regressive tax. And you might be thinking, yeah, but in the same county, everybody pays the same rate. And that's true. I think we actually talked about this in an earlier class because I don't know exactly what Cattaraugus counties is right now. Of course, Chautauqua counties, but they're in the range of 8%. Everybody who buys taxable stuff is going to pay the same 8% interest, or no, 8% sales tax on that, and that's true. The reason it's considered a regressive tax is because as a percent of your income, lower income people buy more taxable, sales taxable stuff. And higher income earners are more likely to be spending some of their money on investments or things that are not sales taxable, saving that money. So as a percent of your income, lower income earners pay more in sales tax, even though everyone pays the same rate. That's why I think the term flat tax might be a little bit misleading. Okay. So questions about what we've done so far? So your employer is going to withhold from your paycheck federal income tax based on the W-4 that you completed and those withholding tables of how often you get paid and what your filing status is and whether you've asked for any additional withholding. They're going to do the same thing if you live in a state that has state income tax, or in a jurisdiction like New York City or the city of Yonkers that has their own separate income tax that you get to pay for the privilege of living and or working there. That's on top of New York state tax and the federal. What other kinds of things get withheld from your paycheck if you are a employee? What other kinds of things might you see on your pay state, your pay stub?
Medicare tax.
Medicare, okay, good, thank you. So there are 2 other, and depending on the payroll system that your company uses, you might see them listed together or separately. And they are, as Michaela just said, Medicare, and the other one is Social Security. Sometimes you see them lumped together based on, and you might see this term, FICA, Federal Insurance Contribution or Contributory Act. And it refers to the statutes that created Social Security and then later on Medicare. In the resources, there's a link to an article that gives you kind of the history of Social Security. And I think that's very interesting. And again, to be a well-informed taxpayer, you should kind of take a look at that. Medicare used to be a proportional or a flat tax. And now it is somewhat progressive since the passage of the Affordable Care Act, also known as Obamacare, in case you don't know what I'm talking about. Medicare is a 1.45% tax. 1.45% of every dollar you earn is withheld for Medicare. What I think many people do not recognize is that, yes, that is withheld from your paycheck, but your employer also matches that. So 1.45 comes out of your paycheck, 1.45 is also paid on top of your earnings by your employer. So there's a match. As I said, it used to be a proportional or a flat tax because everyone paid the same 1.45%. But since Obamacare, since the Affordable Care Act, there is a Medicare surcharge of an extra about, whoops, yeah, that's not what I meant to write, 0.9%. So there's a surcharge on upper income earners. If they earn more than a certain amount, they pay an additional almost 1% in Medicare. Okay, everybody pays that every dollar you earn. And I'm just realizing there's something else I should have pulled up before class. I'm just going to have to pull that up in a second because I don't know the number off the top of my head. I should have pulled it up. Social Security, in case you don't know, Medicare is the government provided health insurance for people who are 65 years and older. At this point, everyone is eligible for Medicare automatically, just based on your age. In other words, there's no means testing. It's not based on your income or your assets. It is based strictly on your age. Social Security, the tax rate for Social Security is 6.2%. And again, your employers match that. And that's something I don't think people are aware. So another 6.2%, a total of 7.65% of your check is being withheld for Social Security and Medicare. In my entire working life, which goes back almost 40 years at this point, because I started working when I was 14, it has been 6.2, 6.2 for Social Security, with the exception of 2 years in the mid-2010s when there was a recession and there was an effort to put more money in the hands of spenders, consumers, to spur the economy. And so for that 2-year period, which was like 2013, 14, or 14, 15, maybe 13, 14, the tax rate was lowered on Social Security for the only time in my working history where employees were paying in 4.2%, but during that 2 years, the employer was still paying in 6.2 on your behalf, kind of behind the scenes and hidden from you. If you look at that Social Security history article I have linked in the Chapter 10 folder, you will find that the rates at 6.2% is significantly higher than it was when the system was first passed, first implemented. Medicare, as I said, is slightly progressive now because of that Medicare surcharge on upper income earners. Social Security is regressive, and I'm going to show you why. because Social Security is only assessed on the first X number of dollars of earnings in a given calendar year. And the reason I had to pull this up is because it goes up every year. So you can see that for 2022, the Social Security wage base is $147,000. Last year it was $142,800. You only pay Social Security up to on dollars up to that amount. If you have 2 or more jobs that combined to make that total, you will have Social Security withheld from all of your jobs for the year, if one of them is not over that threshold. And then at the end of the year, when you file your taxes, like you probably have done in the last few weeks here, when you do your tax return, you will get any excess payment refunded to you as part of that tax calculation. So on the first, now $147,000, everyone pays the same amount. But after that, you don't continue to pay in. And the reason for that is because there's the original intent of the Social Security or FICA system was that you paid in, you get back. And since there's a limit on how much you can get back, what your monthly Social Security check is, there's also a limit on how much you pay in. So that's the justification for that. Again, Medicare, a bit progressive, Social Security actually regressive. Questions about any of this so far? Okay. So let me talk a bit more about how the tax is calculated. So as I showed you the tax brackets, it said X% of your taxable income. And that taxable income is not all of your income, it's only a portion of it. And that's why on those withholding tables, you may have noticed near the top of those withholding tables, the withholdings were all 0. And the reason for that is because there is a large percentage of people, it hovers between 45 and 50% of people who are wage earners in the United States, but actually do not pay any federal income tax or do not end up owing any federal income tax. There's a large percentage of people, in fact, who are recipients of federal income tax dollars through the earned income tax credit and other refundable credits like that. And so not only do they not pay any income tax, they actually are paid from the federal income tax system. So I want to talk about how that taxable income is calculated, and this is a much simpler conversation than it was prior to 2018, when the tax code was partially overhauled and simplified. So we start with something that's called your gross income. And your gross income, gross means total. We've talked about that word. We've used that word when we talked about accounts receivable, for example. Gross income is the total income that you've earned. So it might include wages, interest, dividends, any other payments that you received. If you are working as an independent contractor, that income, the 1099 income, would also be included there. And then there are some adjustments, and we're not going to go into what the adjustments are, but there are adjustments for things that are considered not taxable. In the past, it has included child support and contributions to some tax-advantaged retirement savings plans such as IRAs. So we subtract those adjustments and we get to what's known as your adjusted gross income, or your AGI. And that is the number that is the most commonly used. When you're filing your taxes, if you're e-filing, for example, they will ask you for your adjusted gross from last year's tax return to verify that you are who you say you are. There's a whole lot of tax fraud, people claiming refunds for people who they are not, claiming someone else's refund. And so there are some ways that the federal government has tried to restrict that or tried to lessen that. It used to be from your adjusted gross income, we would subtract exemptions and deductions. And I already mentioned when we looked at the W-4 that exemptions are based on the number of people who are basically dependent on your income or living in your household as dependents. They don't have to live in your household. Again, we're not getting into the definition of what a dependent is, but as I said, in 2018, that whole concept of exemptions went away. And the standard deduction was basically doubled at that time. So most people take the standard deduction. The standard deduction is based on your filing status. So just roughly rounding off, for a single filer, the standard deduction is about $12,000. Again, it's indexed each year, changes a little bit each year. And for a married filing jointly household or tax return, the standard deduction would be twice that, so around $24,000. So about, for a single filer, about $12,000. You may have heard the term itemized deductions. If you can itemize deductions and they add up to more than $12,000, you are allowed to do that through the completion of a Schedule A, which is a list of all of the things that you are deducting, again, if they exceed $12,000 as for a single filer. So for most filers, with the change in the tax structure in 2018, even people who itemized prior to that stopped itemizing because the standard deduction used to be about half of what it is now. And so say $6,000 4 years ago. And so if you had itemized $9,000 worth of deductions, now you would just take the $12,000. You can take the one that's more advantageous, the one that's a higher dollar amount, because that reduces your taxable income. Okay. The kinds of things get included in deductions could include if you have high unreimbursed medical expenses, medical or dental. Most people, in particular, if you have health insurance, are not including medical expenses because they have to exceed a certain percentage of your income before you can deduct them. State and local taxes. This would include property tax and income tax at the state and local level. One of the changes that occurred in 2018 was to cap that state and local income tax deduction at $10,000 total. So again, property tax, state income tax, that really hurt the high tax states such as New York, because it's not at all uncommon, even at relatively modest incomes, to have your state income tax and property tax exceed $10,000. Interest on a home loan. Again, in 2018, that was capped so that the interest on those, what's called a jumbo mortgage, exceeding, I think, the threshold of $750,000. So if you're buying a huge, gorgeous home and your mortgage exceeds that amount, there's a cap on the interest that you can deduct. Charitable contributions, religious organizations, 501c3 organizations such as United Way, JCC Foundation, things like that. SPCA, all of those are considered deductible if you itemize. So those are the big ones. There are some other much smaller considerations, but those are the typical deductions that people would look at to see if the total of all of these items exceeds your standard deduction, then you would take that itemized deduction. Otherwise, you're going to take the standard deduction. And when we look at the tax brackets and it says taxable income, it's based on this calculation. And so everyone has a portion of their income that is not taxed at all. And how much that is based on your filing status, whether you take the standard deduction, whether you have adjustments, things like that. All right, so that is my coverage of the tax system. We talked about withholding, federal income tax, state income tax if appropriate, local income tax if appropriate, Medicare, Social Security. What other kinds of deductions or withholding might you see from your paycheck? Anyone think of any others? New York State has one, has a couple now that are exclusive to New York State. Paid Family Leave Act, withholding, New York State disability. If you have benefits that you partially contribute to, such as health insurance, you might see withholding from your paycheck for your part of your health insurance, or any other kind of insurance, life insurance, dental, vision, any of those kinds of things that might be part of your benefits package and you have a contribution. If you are represented by a labor union, you may see a deduction from your paycheck for the dues or fees associated with your union representation. You may have charitable contributions withheld from your paycheck. So many employers will run a United Way campaign to support the local United Way, and you might have money withheld from your paycheck to go toward your United Way contribution. Here at JCC, we can do automatic contributions to the JCC Foundation that funds the USA scholarships and many other different types of scholarships that are available here. So those are all, those are certainly the big ones that you might see listed on your paycheck. Some of them are voluntary, like the charitable contributions. Some of them are statutory or required, such as the federal and state income tax, withholding, and Social Security and Medicare. Social Security and Medicare apply to every dollar you earn, so it's not just this taxable income part. Social Security, as I already mentioned, up to that wage cap each year. But so that's why in 2014, when they were trying to spur the economy, trying to put more money in the hands of the consumer, a tax cut at the federal income tax level would not have been as beneficial, because about half of people don't pay any federal income tax. And so they had to cut the tax, or they chose to cut the tax that everyone pays, and that is Social Security. And as I said, that stayed in place for 2 years. So we are out of time for today. As I told you, I expected to take up about the rest of class. So when we come in on Monday, we'll look at our next exercise, which is related to payroll calculations, and we won't need to spend as much time talking about where do these numbers come from. Hopefully this conversation gave you a bit more information than what you already knew about how your pay is calculated. And if you have any questions on that, of course, I would be happy to answer them. If you have a question about your personal situation, please don't share additional personal information I don't need to know. But if you do have a question you want to run by me, I would be happy to answer that. Just send me an email or schedule an appointment with me outside of class time. Right. If there aren't any questions, we will stop there. Please remember, if you want to attend the drop-in session tomorrow, to sign up in Starfish. You can come for some or all of it based on your own schedule. All right. See you all on Monday or tomorrow.